Welcome back, my beautiful people. We have a lot more friends on the channel since the last time I saw you. And I wanted to let you know that as we become a bigger and stronger community, I just want to let you know about my commitment that I'm dedicated to providing insights that are difficult to find elsewhere. I missed you guys a lot last week. You could probably guess what I was doing. I was doing a lot of research for you. And I just checked how US and China equities have been doing lately. And let's just say that Mr. Market has been rewarding those who kept their cool the past month or so during the quite annoying noise that we got during the summer. Congratulations if you were on the right side of the trade. But now let's dig a bit deeper. I think beneath the surface, there is a new shadow risk that has the ability to control the market narrative in the coming months. And that risk is the risk of inflation morphing itself into something known as stagflation, which I'll explain very shortly. You see, like I've said in one of my previous videos, a healthy dose of inflation when economic growth is strong is a good thing. Inflation, though, has two evil siblings. One is deflation, and the other is stagflation. Now, in today's video, I want to talk about the looming danger of stagflation, what it could mean for everyone, and how to get ahead of it. I expect stagflation to show up a lot more in the market narrative in the coming months, and the more you know about it, the more you can get ahead of it. I'll be presenting a lot of market data and history to help guide your thinking process on how to stay firm with a data-driven approach. In short, I'm going to get you up to speed on navigating stagflation. Now, to understand inflation's mutation into stagflation, I'm going to walk you through the history of what happened in the 1970s, which was a time stagflation devastated the stock market. I'll then contrast that time period with the environment that we're in today with a greater level of detail and nuance, and then we'll talk about what central banks around the world are doing with their rate policies, which is in sharp contrast to what the US is currently doing. Now, as a reminder, during times of market calm, as we're seeing now, the key is to keep learning, keep revisiting historical moments to keep your skills sharp so that when things get volatile again, you have the right perspective to make proper decisions. So put this video in your watch later tab, in your queue, and rewatch later if you want a continued refresher on stagflation. A few months ago, a lot of you guys pressed the like button and we nuked the bears. Pressing the like button right now will tell stagflation to go away. But of course, don't worry. When things get volatile again, I'll be putting on my tactical thinking hat again to guide you through it. Make sure you subscribe, turn on that lovely bell so that you get insights. Let's first start off by defining what stagflation is. It describes an economic environment where there's high inflation, but unemployment remains stubbornly high and economic growth is very weak. Now, whether you're a beginner or advanced in investing, you can tell immediately that that's not a good mixture. The only time in US history that there has been a severe case of stagflation was in the 1970s. Now, if you want to research this yourself, you want to note down that the precise time period is 1966 to 1982. In the 1970s, the S&P 500 suffered a very steep drop from a combination of weak economic growth, extremely high interest rates, and a high unemployment rate. In the decade leading up to the 1970s, monetary policy was extraordinarily loose. Now, when Richard Nixon assumed presidential office in 1969, he inherited a recession from Lyndon Johnson. And because of that, Nixon had fired then Fed Chair William Martin and replaced him with a yes man, Arthur Burns. To combat unemployment, Fed Chair Arthur Burns shifted from a tight monetary policy to a loose economic policy. And at the time, unemployment was 6% and inflation was already elevated, so they needed to do something. And Nixon's economic strategy was so aggressive that it was later termed Nixonomics. Now, as Nixon came up for re-election in 1972, his office stimulated the country with a $25.2 billion budget. Keep in mind, $25.2 billion back in 1972 is an incredible, incredible sum. During election year in 1973, he increased the money supply by 9%. This was able to keep unemployment low enough and the economy strong enough to get Nixon reelected. The problem came after he was elected. Unfortunately, inflation returned in a big way. Oil prices were high, price and wage controls were lifted by that point, and inflation was 8.8% in 1973 and 12% the year after. It would take significant monetary tightening under Arthur Burns and next Fed Chair Paul Volcker to calm inflation back to historical norms. At one point, the Fed funds rate was as high as 20% in June 1981, which sparked a terrible recession that put the unemployment rate back at 10% in the early 1980s. As you can see, the investment horizon between 1966 and 1982 was a period of significant volatility in the economy and the stock market that made long-term investing an extremely difficult endeavor. It's said that certain sectors were hurt so much by high interest rates during this period, such as farming, construction, and industrials, that there was a noted protest among the farmers forming a blockade around the Esales building, which is where the Fed Board of Governors houses their offices in Washington, D.C. Now, why is all this history so valuable to understanding the present? Because when we carefully understand the environment we're in today, we can see what aspects of the 1970s are directly parallel and what aspects are somewhat different. Mark Twain once famously said that history doesn't repeat itself, but it does rhyme. And so here we are in late 2021, approaching 2022 with the following macro backdrop. Unemployment is now at 4.8%, which is still very elevated compared to historical norms. The all items CPI grew by 5.4% over the last 12 months as of last month's report. Core PCE inflation is at 3.7%. The last 3 job reports indicate that growth is flattening, and GDP growth is also softening. So put in plain English, in everyday terms, we have the backdrop of an economy that could potentially be entering stagflation. The one area that we don't have yet that occurred in the 1970s that triggered a bear market is higher rates. Now, if you've been following me for a while now, you would know that I have been bullish on Chinese internet and US tech, and now the NASDAQ has once again reclaimed 15,000. And I see Q4 of this year being very good to investors, but the question is not what happens this year, but the significant move that might happen next. Next year is a pivotal year for markets if continued inflation forces the Fed's hand. Now, to dive into what kind of macro backdrop that we're seeing to understand central banks around the world, I have found a very powerful table for you to help you understand the growing desire to hike rates among the emerging markets. Now, we can see in this table that while the US is on hold, several countries in Latin America and Europe have already hiked rates in the past month. In addition, a closer analysis at their central bank statements hint at hawkish commentary, which is another way of saying that these countries could be more aggressive at tightening if inflation isn't obviously contained. Now, to give you an even more nuanced perspective, you'll see that emerging markets are hiking their interest rates while developed markets are being a little bit more patient. However, when emerging markets hike their rates, that means that they are actively defending their local currency's value. This in turn means that the dollar will be weaker relative to these currencies. Now, for now, that's a favorable development for everyone because a weaker dollar typically means that the S&P 500 performs better over time as these companies' international operations are not hurt by a stronger dollar. Now, analyzing this table will be very helpful when we consider it in conjunction with some of the most recent statements made by central banks in the developed markets. In a recent panel with ECB President Christine Lagarde, Bank of Japan's Kuroda, and Bank of England Governor's Bailey, Jay Powell expressed his frustration that inflation is going to take a little longer to subside and that it could go well into 2022. Now, Powell said the FOMC will definitely respond if inflation becomes a concern. And this is not to be taken lightly, because Bank of England's Governor Andrew Bailey is also reportedly ready to start hiking rates in early 2022. So that means that in the developed markets, you're starting to have a portion of them begin monetary tightening. So when I think about this, my interpretation is that Powell will have a very difficult decision to make quite soon. Either wait for unemployment and slack to pick up, or cool inflation by hiking interest rates. Now, just a note, in my opinion, the US can't decouple its monetary policy from global markets, especially its developed market peers, indefinitely. If we see tightening in the Eurozone and other developed markets, we could see a liftoff cycle faster than expected in the US. Now, in a recent conference in Los Angeles, Randal, who is a top official at the Fed and familiar with the thinking of the committee there, said, quote unquote, that the Fed can tolerate 2.5% inflation for a period of time. However, he was quoted as saying that if the Fed was still seeing 4% inflation by next spring, which is typically characterized by the March-April timeframe in the US for those of you who are my YouTube friends from Europe or Asia, he said that the Fed might need to tighten monetary policy sooner rather than later. He also mentioned that the speed at which tightening would happen could be reconsidered. So rather than gradual rate hikes, it's very possible that an accelerated timeline could be in play. Now, the markets are not pricing any of that in, as the current consensus for inflation is still transitory. Now, I'm still in that camp, but I'll be monitoring monthly CPI very closely because, my friends, the writing is on the wall for rate hikes. For anyone who's paying attention, keep this note down. If the CPI index is north of 4% by spring 2022, we're going to see the Fed possibly respond. So making sure that we're ahead of the curve is very important here. I'm also keeping a very close eye on the core inputs that cause inflation, such as commodities linked to energy and food prices, from the Food and Agricultural Organization, the FAO Food Prices Index. Now, I'm using the FAO Food Prices Index because it measures the change of prices internationally. Now, you might be wondering, why am I not using a US index? Why am I using an international index? Well, this index tells me whether global food prices will influence the central banks of emerging markets to keep hiking rates, given that food prices are a big part of not just CPI, this next part's important, but also social stability. The moment food prices become too high, you don't just have inflation, you've got a bigger problem. You have potentially social unrest emerging. Just as a historical reminder, there was a famine before the French Revolution of the 18th century. At that moment in time, inflation had spiraled out of control because of a shortage of crops. And for the third estate of France, which represented the working class and the majority of the population at the time, bread prices for the ordinary man became nearly 80% of their income. Now, while we in the developed world are nowhere near close to that kind of situation, rising food prices in today's environment has the ability to cause central banks in emerging markets to aggressively tame inflation with rate hikes, which will slow down global growth. That will all end up coming back to our economic figures here back in the US. Now, another important report that I follow closely when markets are more complacent is the Fed's Beige Book. Inside the Beige Book, which is published 8 times a year, we learn about the anecdotal evidence that the Fed collects throughout the US in 12 Federal Reserve districts, which happen to be some of the major cities in the US, such as Boston, New York, Philly, Dallas, San Francisco, and so forth. Now, recent observations from the Beige Book include that the pace of growth has slowed this period due to supply chain disruptions, labor shortages, and continued COVID issues. Now, we could see from the Fed's language that the recovery is uneven, with consumer spending solid, but auto sales declining, and travel still being a mixed picture. So if we read the Fed's Beige Book carefully, it means that our uneven recovery makes the market a stock-picking environment. In other words, if you do not pick the right companies, you might underperform. This is the kind of environment where if you assess the outlook correctly for certain sectors and companies, you can find significant alpha. You do not want to be positioned in areas that are stagnating in terms of growth. Now, this next part's pretty important. The labor market shortage mystery continues to give certain industry production issues. Now, this is big because these issues are leading to increased wages. Now, you might be thinking, what's wrong with that? Everybody wants to get paid more. Here's the problem. This is an important metric to watch because higher wages could dampen the S&P 500's profit margins and weaken their profitability if their growth outlook isn't sustainably strong. And profit margins, in case you have forgotten, are a major factor that plays into the PE ratios of the companies in the S&P 500. If their profit margins are not as high as before, don't expect them to command the same level of valuation that they once did. So what we've seen from the Beige Book so far is that the outlook is now a bit more cautious while wage growth is on the rise. Of course, this is going to be a non-event if growth is solid. Anytime growth is solid, all things are cured. But on the other hand, if growth isn't good, I speculate that companies will not hesitate to restructure their staff in a downturn, and that could keep unemployment high and elevated, and that could weaken consumer confidence. And when consumer confidence is weakened, we will definitely see the outlook being slashed with a lot of guidance in the S&P 500 companies, and that will keep a lid on valuations. Now, here's another issue that I'm seeing, and maybe you've seen this too. I'm seeing a lot of blogs and YouTube videos gaining traction about the topic related to the Great Resignation of people quitting their jobs. So when I think about it, honestly, if we want this labor shortage to be fixed, there's really a simple cure. Tell these people to get back to work and stop complaining about their jobs. Smash the like button so that more people see this video, so that more people get back to work. So back to the Beige Book. Now, in this bottom paragraph, we can see that prices across the board have increased due to supply chain issues, and I'm going to dive into that a little bit more deeply. There was a recent video, very well done by the way, from the Wall Street Journal talking about the delays in the shipping port areas in Long Beach, California. Now, those shipping ports are responsible for a lot of the retail inventory that comes into our stores. There is currently even a mandate from the Biden administration that these ports need to operate for 7 days a week, 24/7, until further notice to keep the work going so that we can enjoy Christmas this year, so that there will be enough products and items to buy for the Christmas holiday shopping season. It's reported that a lot of these ports are experiencing delays because of what? Staff shortages. Now, a couple other important areas to monitor. These supply chain issues also illustrate the important continued cooperation between the US and China in their trade agreements. The US supply chain is already under great stress due to the domestic labor shortage. If its major trading partners, such as China, were to place restrictions on imports and exports, that could unleash an even greater wave of inflation. Now, like I said in my previous video, it's not just Chinese equities that would benefit from improved US-China relations, it's also the global markets, it's also the S&P 500. Notice how more positive geopolitical news from the two countries in the past 3 weeks has sent the S&P 500 back above 4,500. That is not a coincidence, I promise you, that is not a coincidence. I talked about this in a previous video. Make sure to watch that if you haven't. Now, these constructive developments from US and China meetings hinted to me that at the very least, China would not be as antagonistic towards the US in the trade situation, which could exacerbate the US CPI index. In other words, any deterioration between US and China could, as a second degree, force higher prices, inflation, and then force the Fed to take action, which would weaken our economy here in the US. Now, some very important metrics that I'm paying attention to from a valuation perspective in the background include Warren Buffett's famous indicator termed the Buffett indicator. It measures total stock market value relative to GDP. And we can see that for most of the stock market's history, in the past 5 to 7 decades, the highest points of this index typically peaked at around 150% of GDP. Today, we're at 213% of GDP. Now, it doesn't mean that the bull market's party is over, but it would be irresponsible to not at least understand where we are in the cycle. To be fair, we have the S&P 500's earning yields still above the 10-year yield, meaning that equities are still attractive relative to fixed income. We could see here from Ed Yardeni's model that compared to bonds, equities are still attractive. The key here is that the only metric that separates the 1970s investment environment and the environment we have today is that the growth outlook today is still potentially positive, but it's not clear. And that interest rates today are a lot lower. The moment that calculus changes is when I think there will be a swift and vicious change in investor positioning. So make sure that you've got that in your notes. We're not there yet, but it is something that we must be aware of in 2022. So what am I planning to do in the event of stagflation? Here's my playbook. I personally will cut all margin debt if there is confirmed evidence of stagflation, because I expect stock market volatility to make long-term investing quite difficult. The only reason that I'm on margin is that we're in a bull market, and given that margin costs are tax deductible, and the fact that the mega large cap names in the US and in Chinese internet are very attractive, and I believe that they can outperform a 6-7% interest rate, they already have, by the way, I see it as cheap access to capital. The second thing that I will do is that I will revisit my asset allocation. My opinion is that what drives net worth is typically an asset allocation question. It's not a what stock you pick question or what ETF you pick question. In a stagflationary environment, equities will struggle, and there's a high likelihood that cash could beat equities, and cash will be king for deploying for other opportunities. We're not there yet, and perhaps we won't get there, but this is a part of my plan. And I will also do a deep dive into my holdings. Every name that I hold, I'm going to be looking at their streak of EPS growth. I'm going to be looking at whether they've been able to grow gross margins. Because if they can't grow in a way that outperforms their sector, it's possible that these companies get heavily discounted by slowing growth fears. So we've already seen hints of these developments in some pockets of the market. If we look at Snapchat, we look at Zoom, and we look at Pinterest, you might think that's an earnings story. You might think that's a company-specific story. No, that's a stagflation story. And the moment companies can't meet these growth targets, they could get punished very, very quickly. Now, for the bravest of the brave, those with exceptional timing and the tolerance of a warrior, I believe that a stagflationary environment could make short selling a potential powerful strategy in the future. There may come a time in 2022 when short selling is a tool that we must learn to defend ourselves against bear markets, and I might make a video on that in the future. If you're interested in that, put a comment below just so that I can understand your interest. So in brief, I expect the party to keep rolling in Q4 this year and into early next. You and I, my friends, have successfully ridden a very powerful Chinese tech rebound, and there's more to come. But at some point, we have to be prepared for a potential Fed policy mistake. So some key areas that I'm following include emerging markets and their rate hiking cycles, developed markets and their central banking commentary, especially the ECB, oil prices to understand where CPI is going, food prices, which can be an indication of social stability, and the EPS growth of companies that are the key leading indicators in their industries. Now, this is a lot to follow, and if you don't have the time to follow all of these things, the solution is very simple. I am here for you. So subscribe to my channel, turn on that bell, and share my channel with as many people as possible. You can see that I do a lot of research. And longer term, the more power you give me, the more resources I will have to invest in tools in the future that I could use to do even more powerful research for you to give you those leading insights. Now, if you want my latest thoughts on how to interpret inflation, make sure to click on this video here. And if you want to learn about an investment strategy that has weathered bear markets a bit better than the overall index, then click here. It's time for me to get back to research. Guys, as you know, you are all very awesome. I will see you next time.